So I was standing in line for coffee this morning and I was, just staring at my banking app.
hmm
And you have that moment, you're looking at your balance and it feels so solid, so real. You think, okay, there's a little pile of gold coins somewhere with my name on it.
It's a very comforting thought.
Yeah.
Very DuckTales.
Exactly. I'm picturing a physical box. But then I started reading through the source material we have for today, especially this piece on the alchemy of credit. And I realized that number on my screen is, well, it's a lot more ghostly than I thought.
Ghostly is a good word for it.
It's less like a pile of gold and more like a collective agreement we've all just decided to believe in.
Yeah, if you stare at the modern banking system for long enough, it stops looking like a fortress and starts looking more like a hologram.
Yeah.
It works,
Yeah.
but you could put your hand right through it.
Which is, frankly, terrifying. But that's our mission for this deep dive. We're not just talking about checking accounts. We're really trying to look at the plumbing of the entire global economy. We're dissecting this multiplier effect and trying to answer a pretty simple question. Is the money in our banks real, or is it just a social contract we've all signed without, reading the fine print?
That really is the question. And what I love about the source we're using is that it doesn't just give you a dry lecture on interest rates. It frames this whole thing as a tension between two characters. You've got Sean and Annie.
Oh, I loved that dynamic. It makes it so much easier to understand. So, who are they?
Okay, so in one corner, you've got Sean. Sean's our economist. He's the saver. He's rational. He's mass-focused. He sees a bank, and he just sees this beautiful, logical machine.
And in the other corner, you have Annie. And I gotta say, I really relate to Annie. She's the entrepreneur. She's impulsive, but she's deeply suspicious of the system.
Oh, yeah.
To her, banks are either magicians or they're running a legalized scam.
And the thing is, Annie isn't totally wrong. That's the nuance here. So the goal for us today is to see if we can bridge that gap. Can we take you from Annie's suspicion that it's all a house of cards to Sean's understanding?
Because, spoiler alert.
It is a house of cards, but it's a house of cards that lets modern civilization exist.
That's a huge trade-off.
Okay.
Okay, so let's start where the source does. Section 1, the financial matchmaker. It opens with this really simple scenario. Sean has money and Annie needs it.
Right. And this is like the fundamental friction of economic history. Sean has worked hard, he's saved up a nest egg, but right now it's just sitting under his mattress.
Idle capital.
Exactly. Idle capital. It's useless. It's not building anything. It's not creating jobs. It's just there.
And on the other side of town is Annie. She's got a dream to open a coffee shop. She has the business plan, the energy, but zero capital. She's broke.
So imagine we're in a village 500 years ago. Annie has to physically find Sean in the town square and convince him face-to-face to hand over his life savings.
That is a tough sell.
It's nearly impossible. Think about the friction there. The source calls it asymmetric information. Sean knows nothing about the coffee business.
Right. He doesn't know if Annie's any good at it, or if she's trustworthy, or if she'll just take the money and skip town.
Exactly. So Sean knows his money is safe under the mattress. It might be lumpy, but it's safe. He has no idea if it's safe with Annie.
So 99 times out of 100, Sean just walks away. The coffee shop never opens. The economy just stagnates.
And that is the problem the bank was invented to solve.
See, this is the first big misconception, right? I think most of us, and definitely Annie at the start, think of a bank as just a warehouse for money.
A storage unit, yeah.
I give them my cash, they put it in a box, they guard it.
No,
Right?
if they were just guarding it, they'd charge you for it. But they actually pay you interest.
Hmm.
That's the clue. Storage is a side hustle. Their main business, their product, is risk assessment.
They're the matchmaker, the buffer.
That's it. Sean puts his money in the bank. The bank lends it to Annie. And this is the crucial part. If Annie's coffee shop fails, Sean does not lose his money.
The bank takes the bullet.
The bank absorbs the default. They're selling safety to Sean, and they're selling access to Annie. They bridge that huge trust gap. Sean doesn't need to trust Annie. He just needs to trust the bank.
So what the source is really arguing here is that banks are engines that convert passive savings into active investment. They unlock the energy that's trapped under the mattress.
Precisely. Without that, you just have a world of stagnant money and unfunded dreams.
Okay, so far so good. That sounds pretty noble. Sean gets some interest, Annie gets her shop, everybody wins.
Mm-hmm.
But this is where the story shifts, because Annie, our skeptic, starts looking at the math, and she realizes something doesn't quite add up.
She realizes the bank is lending out money it doesn't actually have.
This is section 2, the magic trick. Or, as the source calls it, the mystery of money from air. And I have to admit, I had to read this part 3 times. How can a bank lend my money out if it's supposed to be holding it for me?
This is the concept of fractional reserve banking. And I'm telling you, it is the single most important engine of the modern economy. And it's also the idea that just breaks people's brains. It feels like cheating.
Okay, let's break it down. The source uses a very clear example with a $100 deposit. I want to walk through this step by step.
Let's do it. So Sean walks into Bank A. He deposits $100 cash.
Okay.
Now, the bank is not legally required to keep that entire $100 in the vault. The central bank sets a rule, the reserve requirement. In our example, let's say it's 10%.
So the bank takes $10 and locks it away. That's the reserve.
Right. That's there in case Sean comes back for lunch money.
Yeah.
But the other $90,
They lend it out.
they lend it out. They give it to Annie for her coffee shop.
Okay, stop right there. Freeze frame. Sean checks his app. It says he has $100.
Correct.
Annie has $90 cash in her hand. So suddenly, there's $190 of purchasing power in the economy. But we only started with a single $100 bill. We've almost doubled the money supply.
You're seeing it. But it doesn't stop there.
Yeah.
This is where the multiplier really kicks in. So Annie takes her $90 and buys an espresso machine from, let's say, Bob. All right. Bob takes that $90 and deposits it in his bank, Bank B.
And Bank B does the exact same thing.
The exact same thing. They see a $90 deposit. They have to keep 10%, so that's $9, and they're free to lend out the remaining $81.
Oh my gosh. So let's tally this up. Sean thinks he has $100. Bob thinks he has $90. And now some new person, Charlie, has $81 cash in his pocket.
Mm-hmm.
That is $271.
From an initial $100 bill, yes.
That feels illegal. It feels like counterfeiting. If I tried that in my basement, I would go to jail.
That's exactly what Annie yells in the text. She says, "You're printing money." But this is where Sean, the economist, corrects her. And it's a really important distinction.
What's the distinction?
Banks aren't printing currency. They aren't printing green paper rectangles with presidents on them. That's the government's job. They are creating credit.
What's the actual difference? If I can spend it, it feels like money.
It functions as money, yes, but it's money that is born from debt. Think about it.
Yeah.
That extra $171 only exists because someone made a promise.
Annie promised to pay back her loan. Charlie promised to pay back his.
Exactly. The money supply expands because the web of promises expands.
So money in this system isn't really a token of value. It's a ledger of trust.
That is a perfect way to put it. It's just a tally of who owes what to whom.
Right.
And the source actually gives us the formula for this, the money multiplier.
Right. I wrote this down. M equals 1 over R.
Simple algebra. The multiplier equals 1 divided by the reserve ratio. So if the reserve is 10% or 0.1, the multiplier is 10.
Which means?
It means that for every single dollar of base money the government actually prints, the banking system can theoretically create up to $10 of broad money through this lending cycle.
It's an amplifier.
It's pure leverage.
Yeah.
And this is why economists like Sean defend it. Imagine if we had full reserve banking where that $100 just sat in the vault.
Well, Annie wouldn't get her loan.
No one would.
Yeah.
There'd be almost no capital available for loans. Interest rates would be sky high. The economy would be tiny, slow, and very safe.
So we're trading safety for growth.
We are. We accept a system where money is stretched so we can fund more Annies and build more coffee shops.
But that stretching comes at a cost. And this brings us right to the next big conflict in the source material, Section 3, the cost of business.
The spread.
Yeah. So Annie gets her loan. She's happy. But then she sees her first statement and she is furious. The bank is charging her 10% interest. But she knows Sean is only getting 3% on his savings. She does the math. 10 minus 3, that's a 7% gap. And to her, that is just pure greed.
It's a fair question. It looks like the bank is just a middleman taking a huge cut for doing nothing.
Right. She's saying, you're just moving numbers on a screen. Why do you get to keep 7%?
But the source breaks down what that spread actually is.
Yeah.
It's not just profit. It has to cover all the mechanics of the system we just described.
You mean overhead, like paying for the building and the tellers?
Sure, that's part of it. The salaries, the compliance teams, the cybersecurity, that all costs money.
Okay, I get that. But 7% still feels high just for overhead.
That's because the biggest piece of that spread isn't overhead at all. It's insurance. It goes right back to that risk transfer we talked about.
Explain that. What are they insuring against?
Okay, so say the bank makes 10 loans. 9 of them go to people like Annie who work hard and pay it back. But one of them is disaster. The business fails. They default.
Money's gone.
Poof. Vaporized. But remember, the bank still owes Sean his original deposit. Sean doesn't care that borrower number 10 failed. He wants his $100 back. So where does the bank get that money?
Ooh, it has to come from the interest paid by the other 9 borrowers.
Bingo. The good borrowers subsidize the risk of the bad borrowers. That 7% spread is a risk pool. If the bank charged 0 spread, the first default would bankrupt them and Sean would lose everything.
I never thought of it that way. My mortgage interest is basically paying for someone else's potential default. It's like a community insurance policy run by the bank.
That's exactly what it is. And the bank's profit is their fee for organizing that pool and taking the hit if defaults get too high.
So Sean explains this to Annie, and she kind of grudgingly gets it. But then the source takes a dark turn. It moves from the mechanics to the psychology. Section 4, the house of cards.
This is where things get a little scary.
Yeah, because we've established that thanks to the multiplier effect, the bank only has a tiny fraction of the money on hand.
Right, that 10% reserve.
So if I walk into the bank today and ask for my $100, they have it. But if I and Bob and Charlie and every single person listening right now all went to the bank at the same time,
They don't have it. It's mathematically impossible for them to have it. The cash isn't there.
and Annie has this sudden realization, my money isn't there.
And Sean, again, corrects her. The value is there. It's changed form. It's not in green paper rectangles anymore. It's in the form of Annie's espresso machine. It's in a house, a car. It's what economists call illiquid.
But I can't pay my rent with an espresso machine.
Exactly. And that leads to the nightmare scenario. The bank run.
The source describes it so well, a rumor starts, doesn't even have to be true. Someone tweets that the bank made bad loans. Sean sees the tweet and gets nervous. He thinks, I better get my cash out before it's gone, so he runs to the bank.
And Bob sees Sean running. He has no idea why, but he thinks, if Sean is panicking, I should panic too. So Bob runs.
And because the bank only has 10%, once that first wave of cash is gone, the doors lock. The bank fails.
And the tragedy is, the bank might have been perfectly healthy. They might have had great assets. But because everyone demanded liquidity at the exact same moment, the system collapsed.
It's a self-fulfilling prophecy. The fear of failure creates the failure.
And that gets us to the core thesis of this whole deep dive. The math matters, the ratios matter. But the only thing that actually holds the molecules of this system together is trust.
It's just belief.
It is purely psychological. The second Sean stops believing he can get his money, the money effectively ceases to exist for him.
That is terrifyingly fragile. It sounds more like a religion than a science.
It is fragile, which is why, as the source points out, we don't just rely on good vibes anymore. We learned that lesson the hard way in the Great Depression.
When thousands of banks failed just from panic.
Right. So we engineered what you could call Trust 2.0. We built in some backstops.
The source mentions 2 big ones, the central bank and deposit insurance.
Yes. So the central bank acts as a lender of last resort. Basically, if a bank is healthy but just ran out of cash in a panic, the central bank can step in and say, here's $1 billion, pay everyone who wants out.
Which stops the panic because once people know the money's there, they don't want it anymore.
It breaks the psychological loop. And then you have deposit insurance like the FDIC. That's the government saying, look, even if the bank burns down, we personally guarantee your savings up to a certain amount.
It's artificially manufactured trust.
It's a trust prosthesis.
Yeah.
It lets us sleep at night. It lets Sean leave his money in the bank, which lets the bank lend to Annie, which lets the economy grow.
So coming back to our characters, where does Annie land by the end of all this?
I think she lands in a place of cautious pragmatism. She realizes that, yes, the system is weird. Yes, money is basically conjured out of promises. But the alternative, that mattress economy, is just so much worse.
It's the least bad system we've managed to figure out.
It's the most efficient system for connecting someone with an idea to someone with capital. It merges the past our savings with the future our investments.
It really changes how you think about just swiping a credit card. You're not just moving money, you're tugging on this massive invisible web of promises that stretches all the way back to the central bank.
And you're trusting that the web will hold. Every transaction is a small act of faith.
So here's the thought I want to leave everyone with. We've been talking about that formula, M = 1/R. The multiplier depends on the reserve. But the source suggests the real variable isn't R at all. It's confidence.
Right. Without confidence, R doesn't matter. The whole thing collapses.
If money is just a tally of promises, what happens in a world where we stop trusting each other to keep those promises? If our trust in institutions erodes, if trust in our neighbors erodes, does the math just stop working?
That's the scary thought. If the story we tell ourselves breaks, the money dissolves. We think of money as the foundation of society, but this deep dive really suggests it's the other way around. Society and the trust we have in it is the foundation of money.
If the trust goes, the gold just turns back into paper.
Or into pixels on a screen.
A little existential dread to go with your coffee this morning.
Do my job.
Thanks for diving deep with us. We'll catch you on the next one.